Good morning, good afternoon, good evening, depending on where in the world you're participating from. We're very pleased to welcome you to today's broadcast of the workshop on entrepreneurship and the financing of innovation. I'm very pleased to welcome today Raghu Rajan, who will be presenting work with Luigi Zingales and Krishna Kamepalli on the kill zone. So without further ado, Raghu, let me turn it over to you.
Great. Thank you, David. And it's always a pleasure to be talking to a large number of participants as you have here. And thanks for inviting me. So this is about what is called the kill zone. And the kill zone is really something the venture capitalists refer to as a space that is proximate to large digital platforms, where the fear of the platform taking over entities in that space is high enough that the venture capitalist is reluctant to fund any investment in that space, right? And we have two quotes here from both Albert Wenger, a venture capitalist, and Senator Elizabeth Warren, of course, somebody who pays close attention to business. And basically, both of them complain about the ease of acquisition around the platforms. And to some extent, this is something which is a little surprising, right? Because we think that the prospect of being acquired and selling out for a high price should spur, not stifle, innovation and investment. And, in fact, we have papers, for example, one by Gordon Phillips and co-author on how, very useful these acquisitions are in encouraging innovation. So what do the data say for these software platforms? Well, here's a crude take at the data. What we have here is the number of deals in the social media space, early stage investments by venture capitalists. And what you see is that this tends to peak around 2014, which is the year of the Facebook acquisition of WhatsApp. Now, nothing here says anything about cause and effect, or even whether this is a sensible metric just to look at the number of deals. But it gave us some hope. Actually, we looked at the data after we wrote down the theory, but nevertheless, gives us some hope that maybe we should look at the data more closely. And what we have here is the dollar amounts invested in the social media space. And again, you see a pretty sharp decline in the last few years. So to put a little more meat on the bones of these two graphs, we look at acquisitions which are big enough to matter, and we define big enough to matter as more than $500 million. We don't adjust for inflation. Inflation has been relatively low over this period. So any acquisitions by the two big platforms, Google and Facebook, in the period 2006-2016. And we picked these two because they seem the most controversial around that time. We identify a set of treated firms, and it's important to remember to understand what we're doing. We're picking each acquisition that it turns out there's a grand total of 9, which are over $500 million in this period. And for each acquired firm, we look at a set of firms which are similar to that acquired firm, which are being funded by venture capitalists at that point, at the time of the acquisition. And we look to see what happens to investments in these comparable treated firms after the acquisition by Google or Facebook, with the idea that an acquisition by Google or Facebook is a signal that firms within the space are fair game for further acquisitions. And therefore, do people invest more or start investing less at that point in these kinds of firms, both in terms of existing investments, but also new investments. So we look at similar firms to the acquired firms. One of the caveats is we want similar, but not too similar, for a reason I'll talk about later. But right now, think about it as similar, not too similar. And then we look at what the appropriate investment in these firms should be, adjusting for the state of the cycle. And the cycle adjusted state is basically dividing by investments in the software industry, which we think is comparable to this investment in near social platforms. And we compute the cycle-adjusted measure around acquisitions, plus minus 3 years, and essentially do an event study. And here are the acquisitions that were taken, that were done by Google and Facebook. Some of these names may seem familiar. WhatsApp, for example, or YouTube. And less familiar would be ITA Software, Postini, and so on. And we classify this for reasons we'll come to later as substitutes or complements. Substitutes meaning they're platform substitutes. Complements means they're add-ons which make the platform richer. So we look at the amount VCs invest in these similar treated firms, standardized by the amount VCs invest in all software companies, look at the number of deals standardized in the same way. This is the amount of investment. And what you see here is year 0 is the year that Google or Facebook took over a company. And the blue line is what happens to investments in comparable firms to the firm that was taken over by Google or Facebook. And the red line is what happens to comparable firms when it is just another ordinary software acquisition. What happens to investment in those comparable firms? And what you see is that when Google or Facebook take over a firm, following that acquisition, investment in similar firms plummets by about 40% relative to what was happening in the year of the acquisition. What happens with software firms otherwise is that it goes the other way, that investment actually increases from the year of acquisition by about 40%. So the gap is huge in terms of relative investment before and after an acquisition. And if you think about the number of deals also, again, you see a fairly wide gap, somewhat less, but Google and Facebook acquisitions, number of deals falls by 20% after the Google or Facebook acquisition of a firm in a comparable space, while it's about flat for other software acquisitions, maybe even a little positive. So we'll come back to this empirical work. It's more suggestive rather than testing the details of the model. But what we want to ask is, can we write down a model which would explain this, that acquisitions actually tend to discourage entry in a digital platform world? Is there a model that will give us that? And what we recognize are the key features of this platform world. One or maybe a couple of gigantic incumbents. There is a strong role for network externalities, which is the more the customers on a platform, the more each customer benefits. There are switching costs for some of the customers. It's not possible to go everywhere and stay everywhere costlessly. And you will see that there's a specific kind of customer for whom there's switching costs. You might think there are no switching costs for yourself, but we'll talk about specific customers for whom there are switching costs. And then these are two-sided platforms. That is, the price charged on one side of the platform essentially equals 0. And it's hard to bring that down further. We can talk about that later, but that's one of the features of this platform. And it may be that the platform is making money on the other side by charging advertisers for access to you, but you don't really see that, and that's a feature. So once you put these together, maybe acquisitions can be a bad thing. And here's the intuition, which is pretty straightforward. In any acquisition, given that I'm bargaining with a relatively, given that I'm bargaining about the price I get, it depends on competition amongst the bidders for my firm. And if none of the bids are good, my outside option is to go it alone. Even if mergers are always efficient, I need to have a credible outside option to do that. Now, if there's only one large incumbent platform, basically the first point is taken care of. There's no competition. And so really, this is about bargaining with that incumbent when I'm an entrant. And my real threat is to essentially pull up stakes and stop negotiation. And that means that my go it alone option is of incredible value in the price that I get. Now, of course, that depends on how good I am. If I've got a new technology which is likely to attract customers, that means that I have more intrinsic value. But it also depends, because of the effect of network externalities, on the number of customers I can attract. Because the more customers I can attract, the stronger the network effects, and the greater my valuation to those customers, the more surplus I can get back from them by charging them a high price through advertising. And we'll come back to that a little later. Now, so that means if the go alone option depends on the number of customers I can attract, whose decisions sway those customers? And it turns out we talk about two sets of customers. One, the ordinary customer, people like many of you and me, who basically have little that they want of a platform other than it's actually quite good. But we rely on the word of a lot of early adopters who tell us this particular platform is good and does a lot of funky, interesting stuff well. Now, who are these early adopters? We call them techies, but you could think of them as early adopters or app designers. And we argue these people have switching costs. If you're a techie who's a real geek who wants to understand every last detail of the platform, they basically have costs in figuring out everything and how it works, especially if things aren't standardized in the industry. And so they have to be willing to invest those switching costs in order to shift to the new entrant platform. Similarly, app designers, they can't just port over their app to the new entrant. They have to adapt it to the features the new entrant has. That also implies switching costs. So essentially, what we have is a situation where you have an incumbent who already has all the early adopters, app designers who have made stuff for the incumbent platform. The entrant has to attract a bunch of them away. Starts with a disadvantage. They're already with the incumbent, but has to persuade them to invest the switching costs in moving to the new platform if they are to provide any value to customers. Remember, more customers I have, more value I provide to them. And this then suggests a disadvantage of acquisitions, because if the authorities permit easy acquisitions, then the early adopter app designer is going to make the following calculation. Once the acquisition takes place, my incumbent platform is going to basically adapt the new technological advances of the entrant to the existing framework. They're going to standardize everything. All the functions will work as they've worked before, maybe better. Maybe there might be one or two new functions. So I really don't need to adapt my app to these changes, because they're going to take care of the portability. In other words, switching costs come down significantly if the acquisition takes place and the incumbent changes things, right? So what this means is, if I think the acquisition is going to take place with high probability, why invest the switching cost now to go to the new entrant? Why not wait till the acquisition takes place, in which case switching costs go down to zero? And well, zero is obviously an extreme assumption, but it gets totally reduced. And what that means then is that ordinary customers who come after that initial set of early adopters / app designers, they're going to say, well, nobody switched to that new platform. And given that nobody switched to that new platform, why should I switch? Because the network externalities are going to be very low. There are no apps to work with it, etc. So I don't really care. I'm not going to switch. And so the ordinary customers who switch falls significantly. And therefore, the standalone valuation of the entrant also falls significantly. The acquisition price falls. The incumbent can buy the entrant's technology at close to nothing, because the entrant has little ability to survive without any customers. And therefore, given that the price of acquisitions are far below any notion of true value, it depresses investment in the potential entrant up front. Venture capitalists say no point going there because we'll get taken out at a very low price. What is important here is there is no overt anti-competitive behavior by the incumbent. In fact, the incumbent does nothing. The incumbent just hangs around, but the nature of the structure of the problem means if I increase the probability of acquisitions, if antitrust is very lax and says you can acquire anybody you want, and the incumbent basically always wants to acquire because that's the nature of the problem. It's always better to be together, given the network externalities, than to be separate. This means that the number of customers who switch is going to be very, very small, and that's going to limit the price that the entrant gets. Okay, let me quickly walk through the model. I mean, the intuition is what I just said. It is a little more complicated because we have to deal with network externalities. Whenever you have network externalities, I do something if I think others will do it. It obviously leads to multiple equilibria. And the classic case is bank runs. If I take my money out, if I think others are taking their money out, I want to take my money out. In that context, we had this application of global games, so initially to models like banking, but it turns out it's a very natural fit in this kind of framework. If I think many customers will switch, I too will switch, while if I think no one will switch, I won't switch. The problem with banking models a la Diamond Dybvig is it depends on some sort of sunspot. I can just think one day, wake up and say, everybody's going to the bank. I go to the bank. And if everybody thinks the same thing, we're going to have a bank run. So in order to get some relationship to fundamentals, and that's the beauty of the global game structure, you can essentially link it to some underlying fundamental, because we all see some information which causes us to be more predisposed to either switch or to stay. And so that's what we're going to do. We get a unique equilibrium. The equilibrium is related to fundamentals. It's not a random sunspot. And it allows us to do comparative statics, which is really what we want to do, because we want to see what is the effect of bringing the merger data close or to postponing it indefinitely. So this is where technology means I have, anyway. We have an incumbent platform I threatened by a new entrant platform E, and the quality of the incumbent is normalized to 0. So the incremental quality of the entrant is theta. That's the key technological advantage it has. And then there are two groups of customers, the techies or early adopters or app designers with measure lambda. These are the guys with switching costs who move early, and then ordinary customers with measure 1 who move afterwards. And David, just tell me when there's 5 minutes left so that I can make sure I finish everything, please.
You've got 20 minutes still.
Yeah. So techies are geeks who like to figure out every last detail if they adopt a new platform, and therefore they have switching costs to move from the incumbent platform. Now, they see the entrant and they see a common signal about the quality of the entrant, so that their posterior on theta is distributed normally with mean Q. Q is the quality then that they impute, mean quality they impute to the entrant, that is their estimate of theta, and with precision alpha, okay? So having observed the signal, they decide whether to switch or not, incurring the switching cost. And let's assume their switching costs are distributed uniformly between 0 and S upper bar, okay? So they basically get a lot of utility from showing off. They pretty much don't talk to anybody, but they like to be influential. So they switch early at date 0, and they have a followership. If they wait to switch, which they could, their decision gets lost in the crowd of ordinary customers switching. Nobody knows that they in fact are early. So they need to switch upfront, and they get an per period incremental expected utility of theta after that, the expectation of theta, which in this case is Q right now. Ordinary customers don't have sufficient information to switch at date zero. So they wait and watch to see. They also they enjoy network externalities, which we assume the initial switcher doesn't. It can be accommodated. It just simplifies the model. If the techies don't have network externalities, they really don't enjoy company. The ordinary customer does enjoy network externalities, and their value of being on a platform is the expected platform quality plus the total measure of customers, both techie and ordinary, who opt for it. Okay. So at date half, ordinary customers have two pieces of information in making their switching decision. They see how many techies switched, and therefore how many stayed, and therefore what the queue that the techies saw was. I mean, we don't need them to infer it. The techies could broadcast what queue is, doesn't matter. It's an input into the decision of the ordinary customer. They also see a private signal of incremental entrant quality, and this may, you could treat this as a private signal. You could treat this as different attributions to quality. But basically, the signal they see is the true underlying quality theta plus some noise, and the noise is distributed mean zero precision beta, right? These guys have no switching costs. Again, we could incorporate switching costs at relatively low cost, but it complicates the model. One way to think about it is you and I, would go from one platform to another, learn some of the basics, but wouldn't take us more than a few minutes to do that. And these guys don't have such a strong attachment that they'll switch back and forth. They switch once at date half, and that's it. And finally, the merger game. Let me talk a little bit about the merger game before we go to the solution. At date one, that is one period after those initial techies decide to switch or not, the two companies come together and decide whether to merge or not. And the share of merged value each party gets is determined through bargaining. And this is a standard bargaining model, which I'll come to in a bit. If they do merge, the superior technology is adopted by the merged entity and all customers enjoy it. So this makes sense in this model because being merged means everybody enjoys the collective network externalities and it's not partitioned. You enjoy yours, I enjoy mine. It comes together. If the two companies do not merge, which is an out of equilibrium event, they will survive n more periods independently. And so this is the timeline. Date zero techies see the public signal, decide whether to switch or not based on their switching costs. Date half, ordinary customers see the techie switching, understand what queue is, see their own private signal and decide to switch or not. Date one, they decide to merge the incumbent and the entrant, and the customer stays with the choices they made from then on. Now, what will be important goes back to the intuition is how many customers switch, because that determines, even though they merge, so all the customers come back together at date one, the number of customers who switch determines the price, because the customers who switch set up the standalone option of the entrant, and therefore in the bargaining game, give them a leg up. If enough customers switch, their standalone option looks very good. They can get a lot of value from the customers who have already switched, and therefore they can hold out for a high price in the merger game. That's really the critical aspect of this model and what's going on. So let's solve for the customer decision. First, the techies. If the techie switches, they expect to gain Q, that's the expected quality differential, for 1 plus m periods, where m is 0 if the merger takes place at date 1, so that they enjoy the incremental quality only for 1 period, and m is equal to n if it never takes place, right? Remember, once the merger takes place, whether it, basically they will enjoy Q regardless of whether they switched or not. That's why essentially they're comparing this Q that they get for the period that the merger hasn't taken place. That's where they enjoy the incremental quality. And if it never takes place, they enjoy the incremental quality forever or for period n. N is the time that the innovation has value, after which the innovation has no more value. So This is the switching decision. I basically benefit from the incremental quality of the entrant for 1 plus m periods. And the quality, incremental quality, I think is Q. So if 1 plus m times Q is greater than my switching cost, I switch, which means the measure of techies who switch, given the uniform distribution, is lambda times 1 plus mq divided by s upper bar, provided it's within these limits. If it's not, we have to carry around an additional term. We assume it's within these limits.
Raghu,
Okay, yeah.
just a quick question. It seems like an innovator, if it were within their power, would like to shape the innovation in a way that such that the switching costs were low.
Yep.
I guess you're envisioning this switching cost being is something that can't be influenced by the innovator. But if I looked at your equations and I was an innovator, I would want to do everything in my power to make a product that was easy to switch to.
Absolutely, and to some extent, sort of one way to think about it is, these guys sort of there were no standards in the industry, and these guys, when they innovated, did something which was a little different, which required, what would solve this problem, as we'll come back to later, is not prohibiting mergers, but having interoperability and common standards in this industry, so that the linkage points are all standardized. What lies behind, I don't need to know. But once I can standardize the linkage points, then the early switchers have few costs, because they really don't need to go into the details what lies behind, so long as the APIs are pretty standard and they can link on, right? So absolutely right. That's what's key, and you will see that in just a second. So ordinary customers observe how many techies have switched. Since they know M, they can back out Q. We don't need something so elaborate. They can the techies have no incentive to lie about Q, so they can blare Q from their blogs or whatever at the top of their voice. And the techie, combined with the private signal they observe, each ordinary customer has a posterior belief of the quality differential, right? Two normal distributions, they're going to add them up and get a posterior, which weights each of the means of the normal distributions, the private signal, as well as Q, by the relative precision to get the new expectation of quality rho I. So that's what, as an individual customer, I go in, I have an expectation of quality after seeing all this. And so then what we get is, if I have an expectation of quality of rho I, and I think P fraction of ordinary customers will switch. Remember, P can be anywhere between 0 and 1. And of course, the only information I have to infer what P might be is my own signal rho I. So P is a function of rho I, plus the number of early sort of adopters, the techies who switched. So the first is my rho I is my relative expectation of quality. The second and the third term, the number of ordinary customers, as well as the number of techies who switched, represent the network externalities. So this sum is my expectation of network externality adjusted quality of the entrant. And that has to be greater than equal to the quality of the incumbent. And remember, the incumbent has the remaining customers, the ordinary customers who didn't switch, that is 1 minus P, as well as the techies who didn't switch, which is lambda minus 1 plus m lambda cubed divided by s upper bar, right? So on the left-hand side is the ordinary customer perception of the incumbent, of the entrance quality. On the right-hand side is their perception of the incumbent's quality, and they switch so long as they believe the entrant network externality adjusted is better than the incumbent. So this is the typical global game. And to solve it, we conjecture that the ordinary customer has a switching strategy, which is, if they believe rho, that is their posterior on quality, is higher than a threshold, this should be posterior after all the signals they see, exceeds the threshold, then they will switch. And when a customer is the marginal switcher, she or he has to believe that a fraction P of customers will switch as well. And so what we do is we calculate if I'm the marginal customer, what should P at the switching point be? And substituting in, this is the equation we solve for what that switching point is, rho star plus 2 times, you can see the derivation of this in the paper. This is basically the equation which gives us what the switching point will be. What is interesting is once we use global games, basically you get a unique solution given this assumption. And that solution depends on both Q, that is the public signal, that is our measure of fundamentals here, as well as it turns out on M, the number of periods for which the entrant will remain independent and no merger takes place. And here is the basic sort of graph you want to get the intuition for. On the x-axis, what we have is Q, the public signal that the techies get on quality. On the y-axis is the switching point. And obviously, the lower the switching point, the better for the entrant, because more customers will switch given any particular posterior they have on quality. And what you see here is that for n equal to 1, the black line, it is above, which means a higher switching point than n equal to 3 when the number of periods is higher, which has a lower equilibrium switching point. And so that is really this basis for the corollary. The optimal switching point decreases and the fraction of ordinary customers switching to the entrant increases in the number of periods that Techie expects the entrant to remain independent. And the intuition, just to emphasize what we've already gone through, longer the period of independence, the more Techies switch for a given Q. This will increase the network externalities for an ordinary customer joining the entrant, and therefore reduce the quality threshold at which they will switch. And this enhances the expected value of the entrant as a standalone entity, right? Important to note, price is not a factor here, right? And that's, you could imagine, David talked about trying to reduce switching costs, but you could imagine them reducing price in order to attract customers. Well, they're already at 0, so they can't really push it below. In the paper, we talk about other ways they could possibly pay people. Paying people to switch has the problem of adverse selection. You may have people creating bots which switch and collecting payment for that without actually using the entrant platform. But that's a discussion we have in the paper.
Raghu, you're right about the 5-minute mark.
Yes. So let me finish the model, and then I'll quickly go to one empirical table and then the conclusion. So merging is always efficient here because what you get is all the customers on one platform, and both platforms benefit from the better quality technology. Remember, technology of the entrant can be lower than the incumbent, but when you merge, the better technology is used. So the overall value is always higher on merger, right? And here the first term is the quality increment. If the quality increment is positive, the entrance quality is used, and that multiplies the entire set of customers, as well as the network externalities enjoyed by the ordinary customer. That's the second element. The key question is what price the transaction will take place at. And we assume the platform can extract back in profits all the surplus it generates on the consumer side, basically by advertising products to customers or using their data in ways that allow sellers to take advantage of the customer. We assume this customer doesn't see the disutility on the other side, but everything would go through if the other side took back 90% of the surplus and left the customer with 10% of the surplus. Basically, everything would work in that case. Now, what are the payoffs of the entrant? And this is really the last theoretical slide. If there's a probability mu, think of bargaining power as determined by mu, where mu is the bargaining power of the incumbent. The greater the bargaining power the incumbent has, the more chance they have to make a take it or leave it offer to the entrant and essentially put them on their outside option, which is of going it alone. And so with probability mu, the incumbent makes the offer. With probability 1 minus mu, the entrant makes the offer. And if mu is high, essentially the value the entrant gets depends on their standalone value, which, as we've said, depends on the number of customers they attract, which depends on the likelihood of a quick merger. The quicker the merger, the fewer customers they attract. So basically, the theorem is if incumbents' bargaining power is high, essentially the prohibition on mergers is good, at least from the sense of encouraging more upfront investment in technology because the entrant gets a higher price. Remember, from an ex post sense, it always makes more sense to merge. But from an ex ante sense of trying to incentivize investment in technology, investment, financial investment, it makes sense to prohibit mergers when the incumbent's bargaining power is high. And so that's really the model. Is the incumbent's bargaining power high? We would say yes, because they have a lower cost of capital having gone IPO, much lower impatience. Their ownership structure more diversified, less concentrated, and therefore less risk averse. Risk aversion is an input into Rubinstein bargaining games. And the more risk averse you are, the less bargaining power you have. And finally, if you allowed the incumbent to have threats, the threat to replicate the technology shortens the entrance horizon. And essentially, what this means is everything is focused on this idea of the outside option, and that outside option gets better if mergers are prohibited. Let me skip past this because this is pretty obvious. So what we do is test that proposition given the chart I showed you earlier, and essentially, it turns out it works well. The acquisitions by Google and Facebook tend to reduce investment by venture capitalists in a closed space. Now, let me mention one point, which is we said close but not too close. And the reason we want close but not too close is think about Google looking for a particular technology which it thinks would complement it tremendously. And it's the only platform that can buy that stuff. Well, once it buys it, there's no point investing in that technology anymore because Google has chosen its winner, and that technology is pretty useless for anything else. Well, that's why we wanted close, but not too close. Once the princess is married off and has chosen the prince, that position is filled. And so other would-be princes basically become unemployed and don't get any investment. That's what we want to avoid. That's why close, but not too close. So what are the implications? And this is the last slide. Well, one more slide after this. Wenger and Warren are actually maybe theoretically justified. And the data suggests it might even be plausible. And we've had different platforms in Europe, China, the United States. Turns out China bans platforms from the United States, has a flourishing set of incumbents now. Europe always dealt with US platforms already occupying significant space, and Europe hasn't had a significant platform of its own. Interestingly, India just banned TikTok, and soon after it banned TikTok, a whole bunch of entrants came in that space. Not clear, I mean, this is the old infant industry argument, not clear the answers to ban. However, and this is the last point I will make, regulators can affect switching costs, something David pointed out early. And so one way to deal with this is to mandate a common standard and interoperability, which allows all competitors to realize network externalities and make this look more like the standard merger, which Gordon Phillips, for example, has shown works in the right direction. So we're not saying prohibit mergers because it has problems both in theory, which is it prevents the exposed efficiencies, but also practice, which mergers do you prohibit, given some are actually good according to Gordon Phillips and some are bad according to us. Basically, a case-by-case approach will not work. So we think much more working on the interoperability and common standards is the way to go. So that's the, let me leave the conclusions up for a second, but basically saying platforms may have a different structure, and in fact, without any anti-competitive behavior, they might be anti-competitive, and the intuition from 20th century economics may not translate to 21st century economics. Let me stop there. Thanks for being a little easy with the time.
Thank you, Raghu. Thank you very much. We're very pleased to have Florian Ederer as our discussant. Florian, take it away.
Can you see my screen, everybody?
Yeah, we can see you and we can hear you.
Okay, great. Terrific. Wonderful. So thank you very much for giving me the opportunity to carefully read this paper. I enjoyed it a lot, and to also join me here in my makeshift office to discuss it. Now, why am I discussing this paper? I've been told that usually when we write one paper in a field, that makes you an expert. So I guess I'm an expert to some extent in the field of antitrust and its effect on innovation. Writing 2 papers makes you a leader in the field. So you might all now ask, like, what is it that I'm a leader in the field in? What I'm a leader in the field in, is a field that I specialize in, is discussing and writing papers with catchy 2-word titles. Okay? So which is this paper, but this paper, of course, offers much, 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 much more than just a catchy title. In particular, what does it do? Well, it's a very elegant global games model of switching between platforms. So this uses all the technology of Morris and Shin that greatly simplifies, the multiple equilibria that show up in coordination games with network externalities that we see in bank runs, that we see in currency crises, and that we see in anything, essentially anything that has these network externalities. So what's the basic intuition? I think Raghu did a fabulous job getting that across, but since repetition is the mother of all knowledge, let me just repeat it here. You have the main ingredients is that the techies lose out on a quality differential if the entrant is acquired and assumed to be integrated. More techies switch to the entrant if therefore there's no acquisition, because otherwise you don't get that quality differential. The adoption by the techies and then in turn encourages adoption by ordinary customers. And if there's a potential for acquisition because of the fact that the techies lose out on a quality differential, if the acquisition occurs, that then it discourages entry, because you cannot get easily to scale if you don't get as many techies signed up and therefore not as many ordinary customers set up. In terms of the standard trade-off here, you actually get a reversal of what we usually see in these types of models. Okay? Here you get ex post efficiency, but ex ante inefficiency. Okay? So everything is efficient ex post. The problem is that this ex post inefficiency, this misappropriation of the investments made by the superior entrant, okay, that would leads then afterwards to this ex ante inefficiency. Okay? So it's in some sense the reverse of killer acquisitions, where in killer acquisitions you actually get ex ante potentially an efficiency, but you get ex post inefficiency because some of the innovation is terminated, okay? Even though the innovators are actually compensated for it in the acquisition stage. Now, it has a beautiful discussion of alternative assumptions, some of which I'll go into in terms of the model, and then has an evaluation of a particular antitrust proposal. Okay, this particular antitrust proposal is, of course, one that looks specifically at acquisitions, but I think the paper could do a little bit more of looking at other things that would be relevant in terms of antitrust policy. What does this paper do? It also does some empirics. I am personally a big fan of papers that combine theory and evidence. So of course, always then bringing in people or the theorists that say, oh, the model isn't like general enough. Okay, and you get the empiricists, well, the empirics aren't super clean and highly identified and all the wonderful things that we expect from an empirical paper. Here, I think the paper does both. because it motivates what we're doing on a theory, okay? And on the theory side, it rationalizes what happens on the empirical side. And I think that's a great attempt of doing that. It has suggestive evidence that previous acquisitions discourage investment. The VC investment and the number of VC deals declines following large acquisitions of similar startups, but not too similar startups by Google and Facebook. There's a negative post-acquisition effect that's present for all levels of similarity, present for both substitutes and complements, and most importantly, particularly large for these Google and Facebook acquisitions relative to similar other acquisitions. It's a great response, all in total now, to these simplistic arguments that are usually put forward, okay, that people that then shout, oh, this is Econ 101, acquisitions, they always lead to more innovation because the innovators are being encouraged to come up with ideas. So this is a great paper that just gets the point across and is, wait a second, it's not all that simple. Okay. However, where I want to push the authors more, this paper is good, but it needs to be perfect. Why does it need to be perfect? Because there are hugely funded interest groups out there that will stop at nothing at discrediting papers and poking holes into papers. And if you want to know more about this, just go, read one of the recent New York Times articles about interventions in antitrust and how many of the large tech companies have funded research precisely to poke holes at papers like this one. Okay. Now, what I want to do is a fully academic discussion. So if you want to look at the polemics, next time tune in to one of the law conferences where I saw this paper presented and one of these law-funded people discussed this here. Let me just stick with what the academic point says about it. I think where the paper could use some improvement is more transparency about the assumptions. The crucial assumption, everything that's driving really the whole theoretical model, is this fact that when you get acquired, you get a full integration of the quality. Okay? Everything from the entrant comes over to the acquirer. Okay? And so therefore the techies, they lose out on that quality differential. That assumption is crucial, okay? But we kind of only suddenly confronted with it on page 9 with it. Raghu did a fabulous job now in the presentation, okay, of spending 10 minutes of getting that main assumption across. In the paper, it would be great if it wasn't just one single sentence that the referee reads through and suddenly says, where's this coming from? Now, I would dedicate a lot more space to explaining and defending it. One thing that one can also easily do and just say, look, you don't need to have perfect integration here. The only thing that you need is you need to retain some quality differential, okay? Which is that if the thing were to be standalone, it would be slightly better still for the techies. Okay? And then if it gets integrated, maybe not all of the perfect integration comes over. Now that leads to a little bit more complexity afterwards, because that then affects also the bargaining game afterwards. Okay? But I think that's something that's relatively easily addressed. You then get a trade-off between, okay, you don't get full exposed efficiency, but you also don't have to rely on the assumption that everything gets perfectly integrated. Okay? Because really all you need is some kind of driver early on that makes the techies want to have the entrant stay independent. Yeah? And so spending a lot more time and then also thinking a little bit more, where can I slightly relax that assumption? I think that would do a great job in improving the paper. Now, I'm perfectly fine with the assumption of zero prices. Okay, and what the paper does, it invokes this argument that we have a two-sided platform. Okay? Now, if I'm a little bit nitpicky here, is you can invoke that argument, but you don't really explicitly model the two-sided platforms. Now, I don't want a full-blown model a la Whale and Waldinger. I don't need a full-blown model a la Tirol Marty Moore to get that, but at least some small theoretical argument to say, look, this zero price assumption is fine as long as these conditions for the other side of the market hold. Okay? It would also be useful in saying, look, what happens if I don't have those zero prices? How bad? Again, it's just relaxing a little bit this presumption, saying, okay, I don't actually need the full zero price. What I need is I cannot fully get something below. Sort of I can have a price, but I can't charge the price below. I cannot get it as much of sort of the benefits over to the techies such that they come over. There's some restriction that they don't get the full surplus in some sense. Yeah. All right. In general, I'd say a little bit more discussion about what assumptions are or aren't crucial for the model would be great. And ideally with a bit more formalism than what is then coming later in the discussion section. The discussion section I like very much, sort of like what are the alternative assumptions, but there a bit more formalism would be nice rather than just, you know, confronting the reader with walls of text. Now, transparency about results continued here. Theorem 2 is the central result of the paper, but strictly speaking, it only provides a sufficient condition for when prohibiting mergers is going to lead to more ex-ante investment, i.e. more entry. Okay? There's no explanation for when and why that result sort of fails to hold. Okay? In fact, there's like just one sentence basically after that proposition. And then as a theorist, I'm a little bit always annoyed when I'm getting told, okay, go and look at the online appendix to see how the proof works. Okay, so a little bit more detail there, of a little bit more transparency. Okay, this is what we need for this to hold would be quite useful. Okay. The connection between the theory and empirics. Okay, this is one of those theory and evidence papers, okay, that is not really testing the model, and Raghu was super transparent about that. Okay. It would still be useful to state a bit more clearly how specific parameters in the model are reflected in the empirical analysis. We're not doing a structural analysis. We're literally where we are literally estimating some of these parameters, but at least say, look, here's this Q, here's the theta, here's how we think about these things in the empirical analysis. And then this was raised already by one of the Q&As here. The theory doesn't really say anything about substitutes and complements, but they kind of show up afterwards in the empirics. Then you have a paper in the empirics that says, well, substitutes and complements, they kind of look the same. But then I was still wondering, okay, can we think of them somewhat differently in the theory? And would that then in some way help us understand the empirics a bit better? Maybe there's no difference, in which case this is perfectly fine. Raghu also mentioned a little bit this competing explanation of sort of like if we have extremely close ones, okay, this was his princess argument just now. This reminded me a lot of this story of like simply competing to be acquired, simply competing to be chosen here. What would happen if there are several entrants, and what would happen to those entrants who are not acquired? Okay, is this an acquisition or competition story? I think that was brought in quite well in the presentation, but a bit more detail in the paper about it would be nice. Okay, there are a couple of smaller theory issues, and I'll run through them rather quickly. There are a bunch of nice, interesting recent papers on negative effects of acquisitions on innovation. Those are by Leitner, Schmutzler, and Seibel, Steve Callender and Nico Matuszek at Stanford GSB and Kellogg, respectively. They have also a paper on this showing that strict antitrust policy on acquisitions can actually be better for entrepreneurial firms because they then innovate more boldly. For the level effect, there are theory papers by Giulio Federico and Mota and Tarantino. They also identify negative innovation effects of acquisition. Just mentioning these papers and slightly discussing what they do and what you do would be quite useful. Also, if we want to give credit all the way back to who came up with sort of this idea first, I wouldn't just, Gordon Phillips and Alexei Stanov paper is very, very nice, but I'd go back even further and mention Eric Rasmussen's paper in the Journal of Industrial Economics that sort of makes that first argument about entry for buyout. A bit more clarity and justification about the objectives and motivations of techies would be useful. So just being clear about what the Q means, how it's related to the theta, that'd be nice. And then if you want to really stress the micro foundations of what drives the techies, there's a beautiful paper by Arthur Campbell in RAND 2017 about the model of buzz, or sort of what drives or what motivates people to be early adopters. And that's essentially this idea of like, I want to be recognized as somebody who knows about something new. Okay, and so you could use some of the motivation there.
Florian, we're about 1 minute left.
Good, then I'll run through the rest quickly. How difficult is it for the techies to switch over after the acquisition? Okay, There are other ways of addressing the entrant's competitive threat. Is it worse to be acquired than to copy the entrant? Okay, and so this is this, you're mostly focusing on the Facebook, Instagram story, but you could also think about what happens to the situation where Facebook just expropriates features of Snapchat. Okay? What are the distributional consequences of this distinction? Can we also accommodate that in the paper? There's a couple of other smaller theory issues. I won't mention them too much. Some of the alternatives assumptions discussion is a bit vague. And infant industry argument, I find a bit of a stretch. And there isn't all that much discussion of a direction rather than the level of R&D investment. Of course, you focus primarily just on the level of R&D investment, but there might be interesting things to say about the direction too. Empirical issues, I'd like to at least see the main specification as an equation. Okay? A few of the potential confounds, make sure that you outline why do we have certain fixed effects in it, what would happen if we didn't have in there. And then maybe one additional paper to cite would be the paper by Martin Watzinger and his co-authors. They have a beautiful paper in AJ Policy that's forthcoming that analyzes the effect on innovation of antitrust action against Bell Labs. So related of saying, what would happen if we did stuff against dominant incumbents in terms of then follow-up, later innovation by other players. Okay, so my closing thoughts, this is a fascinating question that's addressed in this paper here, hugely important policy implications. I think there's room for improvement, but this paper will undoubtedly be quite influential going forward, and I look forward to seeing a new and improved version soon. Thank you.
Thank you very much, Florian. Raghu, I certainly want to give you an opportunity to respond if you'd like to take a minute. Maybe you could do that while I collect a few questions from the audience here. I see some coming through the Q&A window, but I'm sure there will be more.
Sure. I mean, look, thank you very much for that very thoughtful discussion. And I have your slides, and we will go through that list of papers and certainly follow the suggestions which you've given, which are very useful. On the two-sided platform, absolutely, we need to model that. My only excuse is that's in Luigi's domain right now, and Luigi is a harder guy to get to work, given his directorship of the Stigler Center right now, where he's all enthusiastic about a whole set of antitrust issues that he wants to put on the table. Anyway, yes, we will do that. On the substitutes and complements, we have a discussion, and it doesn't elevate to the level of theory. It's a loose discussion when we discuss all the other assumptions about what would happen in the case of complements. And we certainly make a case that under a certain set of assumptions, it would look very similar. But of course, we need to do a little more. And finally, the fixed effects. Fixed effects are in there. Actually, they do make a difference in some cases, but they have to be in there because each of the acquisitions has a different number of comparators that we have in the regression, and therefore the size of the investment that they're being compared with is quite different in each case, and therefore it's important to keep the fixed effects in there. There are other ways you can normalize the investment also that would do the same thing. Turns out when you normalize, you get exactly, actually the numbers are exactly the same. So, but thank you. This is very useful. And, as always, we sort of venture into an area we know very little about, and we certainly need to learn a lot from your discussion on other papers of what people have done, and we will take that on board.
Raghu, we're near the end of our time, but I did see some questions here in the Q&A window, and so let me offer a question from Lulu Wang, who asks, perhaps as a result of these switching costs that we've been focusing on, firms seem to compete on the basis of business models instead of on the basis of just quality. And in short, she's asking, can your model be interpreted as an explanation for the way innovation seems to be directed towards new business models instead of just innovating purely on a quality dimension? And is this alternative form of competition somehow better or worse than what we would otherwise have if it was just pure quality competition?
It's a great
I'm not sure
question.
how to think about this.
And it's a great question. I need to think a little more about it. But there's something in here which has a rent-seeking kind of attribute to it, right? Remember, the entrant is trying to maximize the value as a standalone, which is really an out of equilibrium occurrence. And that's where your business model may come in, that they're trying to give an alternative sort of structure, even though the customer is better off together. And so they're maximizing value in that alternative structure, which may create a certain kind of innovation, a certain kind of new framework in order to get that out of equilibrium value, which is not useful in the long run because it's going to be closed down. And so that is an interesting feature here. We haven't exploited that, but it's other than saying, yes, you maximize that, but it could take your innovation in an entirely different direction. I innovate so as to attract customers in the short term, but that's only to extract a higher rent from the incumbent. And it may be that this leads to dysfunctional innovation rather than functional innovation.
So yeah, that's very interesting. That's very interesting. Are there other, so Ayako Yasuda writes, what does the model imply for acquisitions where the target companies are allowed to continue operating as independent subsidiaries? So for example, Instagram being acquired by Facebook or LinkedIn being acquired by Microsoft. So there's, in those situations, there's really no explicit integration of the entrance quality throughout the acquirer's existing product to everything. So the integration in some sense occurs kind of at the income statement level, not at the user interface level.
Right. No, for sure. I mean, we have not thought about what happens if that, to competition post acquisition. Our assumption is only that if that entrant is acquired and the pipes to that entrant are made seamless, that is, they made easy for the existing players on the incumbent platform, that's all that we need. So it can be a separately operated subsidiary, but if what they now show up as is a button on your platform, and you just click that to get onto them, and all the pipes are made easy to make that connection, then you get a large part of our model back. What is less clear is if they just held as a subsidiary under the with no connections, in which case I think you get back to the old antitrust issues, not the one we're addressing.
I see. I'm mindful of our time. Let me perhaps I should turn it back over to Michael here. Michael, did you want to say anything about upcoming seminars or?
Yeah, we can, a quick announcement. First off, thanks for the presentation discussion. It was great. Our next WEFI talk is Petra Moser's presenting some work on women in science, evidence from the baby boom. I just put that in chat. And then that's November 2nd. And then November 9th, our next lecture series will be Juan Faramonsa from University of Illinois, Chicago, who's presenting work on private versus public firms, which he's of course an expert in. So both are available for registration. Stay tuned to the website and Twitter feed if you need more info. So thanks everyone for coming.
Yeah, please join me, Mike, Yael, and Song for thanking Raghu for presenting and Florian for his great discussion. Thank you all very much.
Thank you.